And now, ladies and gentlemen, moving ahead, our next session brings into focus one of the most widely debated themes in equity investing: growth versus value. While value investing has its legacy rooted in deep discounts and margin of safety, growth investing has steadily emerged as the more consistent alpha generator, especially in emerging markets like India, where innovation, formalization, and rising consumption continue to unlock structural opportunities. This session, titled Growth is More Dependable Driver Than Value for Alpha Investing, will explore why growth backed by strong fundamentals and secular tailwinds is increasingly proving to be the more reliable engine for long-term outperformance. To take us through this thought-provoking perspective, we are joined by Mr. Arun Subrahmanyam, founder and managing partner at Ampersand Capital. Mr. Subrahmanyam is a veteran in the Indian equity research space with over 25 years of experience spanning both domestic and international brokerage firms. His expertise in fundamental research, built over decades of tracking sectors like automobiles, pharmaceuticals, and financials, gives him a unique ability to identify growth trends early and with conviction. Arun began his career with ICICI and went on to hold key research roles at HSBC Securities, Paribas Capital Markets, and IDFC. His last corporate stint was a remarkable 11-year tenure as Managing Director Research at Bank of America Merrill Lynch, where he shaped institutional equity research before founding Ampersand Capital. Please join me in welcoming Mr. Arun Subrahmanyam as he takes us to the evolving case for growth investing as a dependable path to alpha in today's dynamic markets. Ladies and gentlemen, Mr. Arun Subrahmanyam.
Hello, ladies and gentlemen. I won't keep you long. I know this is the last session before lunch, and it also serves my purpose of making this presentation very short. Kamal has actually, like this lady introduced me, brought me into this very difficult, debatable topic of growth versus value. I don't want to get into this growth versus value trap, although we are a growth-focused fund, but who doesn't want value along with growth? I mean, the more attractive the stock price, along with growth, obviously you can generate much more returns and better alpha. So, apart from the fact that the whole debate is very contentious and I do not get trapped by it, I will try and tell you why, in very short 3-slide presentation, why we prefer growth over value and why we are a growth-focused fund. I'm sorry, I'm very bad at this. How do you get the next? How do you get the next slide, please? Can somebody help me with this? The next slide, first slide. Yeah, I did that. No. Yeah. Okay, while the presentation does get uploaded, see, yeah, thank you. Yeah. So, what we believe is that growth is a long-term driver for creation of multi-cap, for creation of alpha, and which is why we prefer it over value. The reason being that why we think that sustainable growth delivers multi-cap alpha, multi-year alpha, whereas value is highly dependent on certain external or internal triggers. Um, Predictable growth attracts capital, drives liquidity, and lends resilience to valuations. So you can see those two examples which I have given them in the chart. There is a very strong correlation to growth with returns. If you look at the last 10 years, you can see that Nifty has had a very strong correlation. More than 70% of the Nifty returns are attributed to growth. Likewise, if you look at the last 3 years, I've mentioned with some stocks, there are several of the leading stocks. Growth is the key contributor to uh, uh, to growth, the key contributor to long-term returns. So I've given some examples here as to why growth trumps over value. I've taken 4 examples, different sectors. The most obvious one and close to me because I was an auto analyst once is TVS versus Hero. If you had invested in TVS 10 years ago when it was the number 3 two-wheeler company, the returns would have been manifold. And Hero at that point in time was a dominant player in two-wheelers, and it has obviously gone nowhere. It's obviously no long. It is still a dominant player, but with a much reduced dominance. In the last 10 years, TVS stock has completely been driven not only by the earnings growth, but also by the stock, how the stock has got re-rated because of the growth. Hero, on the other hand, has not delivered growth and therefore has got derated. Likewise, there are several examples: Bajaj versus L&T, Coforge versus Infosys, and Trent versus Revenue. These are very common examples. There are many more where you can actually see how growth actually delivers much stronger alpha over a long and sustainable period. I'll get to this ampersand chart in the end, for table in the end, but rounding off with my whole argument on this growth versus value and why we think growth will still do well, although several pockets of the market are not seeing any growth now. Unlike 23 and 24, when a lot of growth stocks were available freely and there was this huge run in the market, the last 8 months particularly have seen growth taper off and some of these companies getting derated as a process. Growth is actually getting to be more and more fewer as we go along. But we still stick to this whole theme of growth simply because even if growth does become more selective, we think the growth premium will increase because obviously people will chase growth for want of returns. But of course, it doesn't need not hold true if you think that there are certain companies which are excessively valued. So people tend to ignore that and say, I'd rather go to value rather than go to stay with growth. That is also possible. But you know, these three slides particularly take care of what the theme was: growth versus value, as why Ampersand is focused on growth and why we believe that growth will be a more sustainable driver of alpha. Um, Before I get to talking about Ampersand and what we do, just a couple of slides onto what next. Uh, I mean, a lot of people have asked questions on where do we see the market going forward. Ultimately, like I said, market is market performance is completely dependent on how corporate earnings grows. If the corporate sector does well, market will do well. Conversely, if that doesn't happen, like we are seeing in the last 1 year, then obviously market will tend to move sideways. But in every point in time, there will be companies or certain pockets which will deliver stronger growth, and that is what we look to target. Um, the point I'm trying to make here in this couple of slides is that if you look at the next phase of recovery or growth, where do you think it comes from? We think a lot of it should come from volume and not what happened in the past. The last 5 years, since 2020, since COVID, there is huge bull phase as we all have benefited from. It came mostly from a lot of supply disruption which happened in 2020 post-COVID. Pricing went up and a lot of companies benefited. Uh, and that I don't think will happen any longer. There has been conversely, what has happened is that has actually hit consumption a lot. High pricing has hit consumption, and RBI's action in terms of making credit more tightening credit last year also reduced credit growth and reduced disposable incomes for people in general, and that actually has impacted volumes demand so far. We think going forward that whole element should change. So this is the big thing which we are actually trying to say. We think that the next 5 years or next 3 years, we should see growing affordability as being the big theme or the big driver for consumption, and that should be probably the reason why Indian markets will continue to do well. Not, I won't say continue, will probably recover and then start to do well. If you look in the past, since 2019, the data I have taken, and look at each of the data points we have actually explored, whether you look at inflation, which was closer to 6% then pre-COVID, and then now it's trending towards 3 or 3.2%, between 3 and 3.2%. Most probably is going to undershoot what the RBI is projecting. So that is the reason why you're actually looking at RBI becoming more accommodative to start with, and probably will again surprise by cutting interest rates. Likewise, if you look at fuel, you look at tariffs, all of it, the inflation was extremely high pre-COVID and even in the initial years post-COVID, and those have started to come off quite dramatically. This is not just a cyclical issue. This is not. This is also structural. Globally, you're actually seeing costs, inflation starting to come down. In India, in particular, for example, cheaper renewable power is likely to keep electricity tariffs down, and some states are already passing on those benefits to consumers. Food grain production is quite robust, and there is we no longer see a threat due to inflation due to that. And also a lot of investment in infrastructure should improve lower logistics costs, and therefore inflation should trend lower as we move along. So I'll get to the 3 slides about Ampersand. I know one of the speakers who came before, he had the luxury of giving you lots of slides on how his firm had done. So I'll borrow some of the data from him, not his data, our data, based on what he has said. So we also have actually done extremely well. But just remember, we are not a PMS or a small cap fund or a mid cap fund. We are a multi cap fund. That does not mean that we cannot invest in small caps and mid caps. We do that on a consistent basis. Ever since we started the fund in 2017 September, we have maintained this whole color or characteristic of being a mid cap fund or mid cap scheme. We have typically allocated 30% to each category. It of course would vary depending on where we see pockets of growth and pockets of valuation favoring us. But this is one of the key criteria of our portfolio allocation. And the reason we do it, again, to borrow what the earlier speaker had said, it is not only to ensure that these companies will do well as a whole, but also addressing the risk factor. The large companies obviously have better, you can enter and exit more easily. So the liquidity risk is adjusted, is addressed, while their growth may not match up to some of the smaller names, but adjusted for the risk, we think it kind of broadly gives a reasonably good blended portfolio of achieving a 20 to 25% growth over the next 3 years. As a result, if you look at us from inception, and like I said, I'll go back to the 1 year period, which I think a lot of people would probably look at and complain. If you look at the last since 7.5 years or 8 year where we are, we have managed to deliver 22% growth, which is much better than the benchmark. And like I said, BC 500 not only is our benchmark, but it is truly represents the kind of portfolio we have invested in, we have constructed. So we have done much better than the benchmark, and also well ahead of the Nifty. So that enables one to create, that has enabled us to create reasonable alpha over a long period of time. And we have done this not only since 17, but if you look at all varying periods except the last 1 year, and I'll come to the last 1 year because you may have questions, so I'll rather address the elephant in the room right away. We have done well over 3 years, 2 years, 5 years, so all periods of time we have tried to be very consistent, and that is the most important mantra for us. Be consistent and try and create as much alpha without taking excessive risk. So coming to the last 1 year, where you see our performance is still in single digits, whereas some others have probably done better. There are two factors for why this has happened. One is the fact that as you know, AIFs, the return you see is net of tax. So whatever taxes have been paid by us last year because of what we have sold during the year has been adjusted for. So all taxes have been paid for. So that is the return you see there. And that last year was slightly higher because it churned a little more than normal. Our churn rate is typically 20 to 25%. We probably went about 35-40% last year. And that also hit us on the other side. What 3 percentage points or something got knocked off because of that on taxes. So that is one. But more importantly, and that is what probably concerns you or probably you look at, track, was there anything wrong in our portfolio? Did we have too excessive holdings in small companies or excessively valued companies? Well, not really. I mean, I don't think it was anything like that. Yes, there were a couple of mistakes, and we did make that correction between December and February. But they were not because the companies we had invested in was wrong. I mean, for example, we had invested in a Zomato or a Trent or a Polycab. We still have holdings in those reasonably large holdings, and obviously, so Trent is not doing well, whereas Polycab and Zomato has recovered all what it had lost during that phase. And they are very expensive stocks if you look at it on headline numbers. But they're very good quality companies. And like I said, I borrow, again, I'll borrow, I don't have the slide, but I'll borrow the investment thesis for why we invested in Polycab. We invested in Polycab, that's the largest holding. We invested in Polycab in 2019, right after the IPO, when valuations, of course, were much better, much more attractive, but so was the market. Market at that point in time was valued similarly. But people did not recognize, I think investors did not recognize the kind of leadership and execution capabilities the company had. We have been holding Polycab since then. We have trimmed a couple of times, but by and large, we have held the stock since 2019. Trent, Varun Beverages, all these companies which followed in terms of our investment happened between 19 and 21. And that gave us benefits in 22 and the years after. So it is not that the companies we invest in give us benefits immediately, but what we obviously expected was that these companies are less vulnerable to drawdowns. And it has happened. It has happened in the past. If you look at the drawdowns which happened during the credit crisis in 2018 or during the war between Russia and Ukraine in 2022 and the election period last year, we actually did quite well in the drawdown period. It was only the combined impact of the excessive outperformance we had actually achieved until calendar 2024. All of that actually came to fore in January and February of 2025, and that's kind of bringing down our overall return. But if you look at our monthly, the latest month is now monthly, 3-month and 6-month return. The 6-month return is, of course, they includes the period of January. But if you look at our July numbers, August numbers, July numbers which have not yet come out, that actually has gone to the 6-month return has become positive. So, and we are actually again not just positive, we are actually doing far better than our benchmark and the other indices. This is something which I've already spoken about in terms of consistency. There was only 1 year, 2022, where we did not do as well as we had anticipated. We kind of lagged, not just the benchmark, we probably lagged most of our peers, but most of the other years until calendar 24, we have been ahead of all the indices, and we stand amongst the top quartile amongst all our peers as certified by a benchmarking agency, three benchmarking agencies. I mean, CRISIL, NSC, and one more Singapore-based agency actually have been deputed by SEBI to do that exercise, and we have stood amongst in the top quartile in all periods, except for one 6-month period, which probably happened in 22. Other than that, um, yeah, this is some of the themes. Which I won't elaborate on these themes. If you want, if you have any questions, I'll speak about it. But some of these are long-standing themes like premiumization, this input substitution, which has been our long-standing theme for the past 4 or 5 years. Um, Energy transition and new age technologies, especially in the ER&D and D and the CDMO companies, where we have made significant investments in the past couple of years. Those have been the more recent themes we have actually preferred to invest. Of course, if you look at those valuations of those themes, they obviously are at the higher end of where one is comfortable with, but the narrative is extremely strong. There's a long leeway in terms of growth, or there's a narrative where you can actually see visibility until 2030 and beyond. So I'll stop here, and I know there's about 11 minutes for my time, but it's probably already time for lunch. But if you have a couple of questions, I can take that. That's it?
No,
Yeah, sure. Outlook for outlook for the next 1 year. See, January, if you had asked, I don't think you would have probably said the same thing, right? What for the next 1 year? So we have lost, 6 months have gone. So we should talk about outlook for the next 6 months. So essentially, like I said, we are at the cusp of a recovery. Now, why the recovery is not coming, I won't say it beats me, but obviously it takes time. Usually there's a lag between, see, last year was a very difficult year for India for the reasons well known. So I won't go into last year. But one of the reasons why we did badly also was primarily because of the fact that the economy was slowing. There was a lot of tightness in the monetary in money supply. RBI has squeezed credit growth, and that it has started to reverse. That it reversed early this year, and it has started to quite aggressively start with interest rate cuts. So that lag, in fact, usually takes about 6 months to start to catch up. And consumption has been very badly impacted, like I mentioned in one of the slides, not just for last year, but it has been sluggish for the last 3 years. I see some kind of recovery there starting probably either not, if not this quarter, at least starting from Q3. So that probably answers your question as to what, how market should behave. And then every other parameter, like I said, if you look at oil prices, if you look at inflation in general, they are actually now reasonably benign, and so that augurs well for our economy. Obviously, what happened in July 31st in terms of the new tariffs, our market is trying to digest. It probably will get stable. The markets will get stable and will probably move on from there. I don't think the impact is going to be so significant overall. Obviously, certain pockets are going to get hurt until they find a solution on how to go about conducting business. So overall in the markets, we think we are going to get back to mid-teens, low to mid-teens return going forward if you look at the next 12 months on a rolling basis. But you asked me what's going to happen in the next 2 months, I really don't know. Yeah.
So how is the liquidity scenario, and will liquidity continue to drive the stock market going ahead?
Yeah, okay. Liquidity is reasonably okay, I think. I mean, I don't have the exact data on how the inflows, SIP inflows, and all are happening. Of course, the issue that two issues here. I mean, obviously, one of the foreigners selling in the market, which of course has again resumed. Temporarily, they had started to buy, they had stopped selling, and they started to buy. That had again resumed, but that again is a function probably of what is happening globally, and there's some uncertainty, and the fact that our markets have actually run up a lot in the last 6 months. So that is one. The second, which probably is a little more irritating factor, is the fact that there's so much paper, in not just in terms of IPOs, but also in terms of promoters selling their shares and going and investing in bungalows and wherever, I don't know. So that is not a very good sign. But that's been happening for the last 1 year. Last year, obviously, market could absorb it. The liquidity was much better, despite the FIs selling, because there was this huge momentum of money flowing in. So that sense, it's obviously reduced a bit. But I think today, if you ask me, well, is the liquidity worse than a year ago? Probably yes. But is it bad? I don't think so. And will it improve? Probably again, yes, because once you start to see better numbers in terms of macro and corporate earnings again, if you look at it, predictably, corporate earnings in Q4 are bad. Q1 is not very good. Q2, we think it will be better. How much better, we'll have to wait and see, because obviously that is something which people are still grappling with. But we think it will be better. Yeah.
Sir, I have one question. So, actually, the data that I was looking at, it seems last 1 year, the returns of the advanced countries like Germany, the returns of Germany, South Korea, US have been like 35%, 30%, 20%, like that. But Indian returns are like -4% in dollar terms. So my question is, have we run up too much ahead of ourselves, I mean the markets, and are we going to see this, lateral movement for a couple of years, is my question.
So, I'm so tempted to call my colleague sitting here who tracks all these macros, and my voice has gone away, yeah, who probably can answer this question better, but he's told me not to call him. So I'll try and answer it my own way. So I'll answer it, which obviously may not be absolutely accurate. To answer the second part of what you asked, did a market run ahead of ourselves? The answer would be yes. Last year, we did run up ahead of ourselves. In fact, if you look at our own portfolio, we are an AIF, and we are not a very well-known people coming and rushing and saying take money, and we don't have a huge inflows every day. So we are typically always fully invested, which we did not do last year. We kept 10% cash because we felt that the economy had started to slow down. There were early signs way back in early 2024, and all these things which I'm saying as it's not hindsight. I mean, it just happened. Last year, the government spending stopped, there were elections, the rains, there were excessive heat last year, and all this impacted corporate earnings last year. So that is the reason why we had excess cash in our portfolio. And markets still did very well. In fact, we did extremely well, not because we chased the market. We are not a momentum investing fund. We held on to the stocks. We've been holding on for a long time, and they gave us excessive returns. And so last year, probably yes, you're right. The market went ahead of itself, and it had to give at some point in time. It gave in January. In fact, it had started giving in September itself, but we felt in our fund, we felt it in January and February. So now I don't think that is an issue. The issue still is, I think, probably in terms of markets waiting for the growth, actually companies to start to deliver growth. Even this year, if you look at it, the quarter one is not a great quarter, but for us, we did extremely well in our fund, despite the fact that one vague phenomenon hit us in quarter one. That rains came in early. The summer set in late, in the sense that summer was not very acute. So some of the air conditioning companies and beverage companies did very badly, where we had a large holding. So we got impacted by that in quarter one. But that apart, the fact is that something or the other has cropped up and restricted growth for us so far. But I think once that returns, market will start to look at it. Investors will start to look at markets more positively.
Sir, I think what you're saying is, like, even though there is a sideways market, but there'll be opportunities of growth, pockets of small growth. So that's what you are identifying, I think.
That always is. I mean, even in the financial crisis of 2008. I mean, I don't know. We are only talking of COVID of 2020. I mean, I've been an investor or have tracked markets since 1990, which is a very bad way to say that I'm actually getting old. But the fact is that markets you always find pockets of growth. It is just that, and we always think that Ampersand, we are obviously in the right places. But if you look at us in January, which we are, but I always tell people, when people look at our performance, before that I tell people, when you look at our portfolio, which did badly in January, were all the large cap companies, not the mid cap and the small cap. And everybody was scared of owning small caps. But that has just happened. So it's a very stock specific situation anyway.
Thank you, sir.
Yeah. That's it? Okay, yeah.
As a portfolio level, what is the P currently?
Ours. Yeah, it's on the higher side. And that's not, I'm not saying it in a defensive way, because the focus is not on immediate growth. We look at companies delivering growth on a sustainable basis. There is one slide, in fact, I'd like you to see, if you don't mind, if I can title this. No, I can't. It says lunch. Anyway, so there's one slide where I have said when we the slide which I missed, and I said I'll go back to it. That slide. Where it come back. No, it'll again go back. So let's leave it. So if you look at our portfolio mix, we typically tend or try and invest companies which deliver sustainable growth over 3 years. We are not some soothsayers who will say that what will happen in 2027, 28. But me and my analyst team, we represent, we've actually worked for the longest time with institutions and foreign brokerages, which had a way and system of, looking at companies and studying companies and how to invest in them and how to do research and on a fundamental basis, which is something which Bhavin actually proudly took 3 slides to explain, and I don't have those 3 slides. But the fact is that we exactly do the same because that's the background, and very similar to his probably. But in our portfolio, even in 2025, the last quarter, of course, we did very badly. Our portfolio earnings grew by 21% last year, when the BSE 500 companies grew their earnings only 9%. Only 9%. So that tells you the big difference. So to answer your question, particularly in terms of PE, the reason the PE is in the early 30s is that it is not about getting a 1 year forward PE. It is about looking at the whole concept of investing in growth is that if you invest for multiple years, you manage to compound the alpha every year. You get an alpha, then you compound it, and that's how you actually get those. And after 3 years, what appears expensive today will appear very, very attractive in maybe 2 or 3 years.
What is the number of stocks?
Typically, we try and maintain up to 30 at the maximum. But the reason I'm saying this is because the reason why even goes to 30 is because the last 5 or 7 names are very insignificant. They either should not be there, we are trying to sell, or we've not been able to buy those stocks. So there's a complete tail. That doesn't matter. So if you look at a core portfolio, typically anything which is more than 3% in terms of weight would be somewhere close to 20.
Yeah, thanks.
Thank you. Yep, thank you.